Pandora will report results after the close today, so we're going to go through our earnings model and take a look at the guidance that management gave us on the fourth quarter earnings call, and we're going to compare that to consensus estimates. So there were a number of changes in our model last time around, just because management changed their own business model. So we had to incorporate a number of new businesses. So if you take a look at our model, we have the advertising and subscription revenue up top, which is the traditional core business. And then they also have the ticket servicing revenue below that. And they talked about this new on-demand music service, which we now have ramping in 2017. So we don't have any contributions in 2016, but management did give some guidance on the expense front for 2016. So there will be some upfront costs associated with that new business. So we had to incorporate that. And then from a valuation standpoint, the company is not expected to be profitable anytime soon, so we had to change the valuation methodology. So rather than using a price-earnings ratio, we're now using a price-to-EBITDA ratio, and they're not profitable on an EBITDA basis through 2016. So we actually had to peg our valuation to the 2017 consensus EBITDA estimate. And we're going to go through the valuation details a little bit later on. But there's one other thing to note. They are looking for a potential acquirer, so there's also the potential of having an acquisition premium associated with the price. So we incorporated that as well. So if you look below our multiple section, you can see that we just have these very simplistic metrics here. So we have what an appropriate M&A premium might be. So we were just saying 25%, and this is an arbitrary number you can change. And then what the probability of an acquisition is. So we have it set at 20%, but again, feel free to change these blue cells. You can download this model on our website, change those cells as well as any of the other blue metrics in here. So visit gutenbergresearch.com, click on the Models tab, and from there you can scroll down to Pandora and just click this icon to download. All right, so let's get started going through management's guidance. And this is the last press release from last quarter, and you can see they give all types of guidance for the first quarter of 2016 and the full year 2016. And then they also gave this new projected profitability details by business. So they gave some interesting details here for the 5-year projections, which, we don't even have 5 years in this model any longer. We cut it off at 2017, but you could still incorporate it into your own model. And then they do give some information about their new businesses. So it's too much to toggle back and forth between the press release, this profit projection, and our earnings model. So we're just going to stick with our model, and you can see in all of these purple cells, we incorporated these comments, and that actually gives the guidance that management had stated in the press release. So you don't have to toggle back and forth. You can just take a look at our comments. So we'll start with revenue. And revenue for the first quarter of 2016 is expected to be between $280 and $290 million. And you can see that the street is in line with that guidance at 285, just over 285. And if you want to take a look at how we get to that revenue, you can scroll down to the segment details. And we split the revenue between computer listener hours and mobile listener hours. And then we calculate the computer revenue per 1,000 listener hours for computer and for mobile. And then we're just multiplying the total listener hours by that revenue per 1,000 listener hours estimate. And that's how we get back to the top line revenue. Then for the ticket servicing business, you can see we just put an extra line in there, and we just have a simple revenue growth rate for that business. So for ticket servicing, they actually did give some guidance on total revenue, which they expect to be between 80 and 90 million for the full year of 2016. And you can see we've just incorporated a steady ramp of that business throughout the year to get back to that total 85 million number. And then for advertising revenue, they gave guidance for full year 2016 of advertising revenue plus subscriptions and other ticket servicing at between at around 1.325 billion. So you can see we're getting back to that number there. And then full year GAAP revenue management guided between 1.4 and 1.42 billion, and you can see that based on the street's estimate for each one of the quarters, we were able to get back to that total management guided number. And then let's scroll down to, so then we have cost of revenue estimates in here. And then we get down to the OPEX items. So they gave some guidance for OPEX. If you take a look here, and this is where it gets a little complex, they gave total guidance for 2016 ticket fly operations to be break even. And we kept the gross margin constant from the prior quarter, and then we backed into the OPEX that would be required to get back to that break-even point for ticket servicing. So if you look, we've got 85 million here, and we've got cost of revenue for ticket servicing of approximately 59.5, which means to get back to the 85, we had to get to 25.5 on the ticket service OPEX. So that's how we got to that number. So you can see how complex the guidance is for Pandora just because of all the business changes, and it takes a lot of work to model this out. But we're nearly halfway done at this point. So management guided 2016 investment in on-demand services to 120 million. So this gets back to what we were saying earlier, that while there's no revenue expected for on-demand music service this year, they're expecting to have $120 million of upfront cost to get that business running. So that's where we're putting in this row here. Then for provisions for income tax, management guided it to about $500,000, and you can see we're pretty close to that mark. It's not a big overall driver of earnings, and you can see we're a little bit higher than we need to be for the full year of 2016 at just under $4 million. So we could actually bring that down slightly in the fourth quarter. Then for shares outstanding, they guided to 227 million for basic shares. So what we did is we took the growth rate that was required to get back to that share count, and we applied the same growth rate for the diluted share count. And they also have a different share count for non-GAAP, so we also applied the same growth rate there. And when we put all those assumptions in, we were in fact able to get back to the street's estimate for EPS of 33 cents. And we also got back to the estimate across the board for the next couple of quarters. But keep in mind, we're no longer valuing Pandora's shares based on this loss per share. We're valuing it based on the adjusted EBITDA. So we're going to have to scroll down to below the segment details to get back to that adjusted EBITDA number. And to get back to it, there are a couple of additional things that management provided guidance for. So first is depreciation and amortization, which they estimate to be about $14 million. So you can see we came right in line with that guidance from management. And for the full year, they expect depreciation and amortization to be $62 million. So again, in line with that estimate. For stock-based comp, they estimate at $38 million. So you can see we have a bit of a rounding difference there, but it's almost exactly what management estimates it to be. And $164 for the full year. And management did give guidance for the adjusted EBITDA. So they guided it between 75 and 65 million loss, and in order to get back to the consensus EPS estimate for that quarter, we actually had to go to a narrower loss of 53 million. So that's kind of implying that the street is a little bit ahead of where management is on the EPS front, but it honestly doesn't even matter for this quarter because the loss is still pretty great. The valuation is really going to take place in the later periods. And then for the full year, we were able to just about get back to the low end of management's loss range at about $60 million of adjusted EBITDA. And then you can see we kept the growth rates in listener hours somewhat consistent with the prior year, and we actually brought our RMPs for computer and mobile down for 2017, and that just reflects the higher royalty rates that the company is going to have to pay. And when we do that, and we basically run through this similar OPEX scenario that we saw in 2016, we would get back to an adjusted EBITDA that's in line with the consensus estimate of $53.5 million. So this is the key metric because that's what we're using in our valuation. So you can see we collapsed the balance sheet and the cash flow statement because we're not actually forecasting the future periods any longer, since we are no longer using this as a tier 1 model. This is tier 2. And if you want to know more of the details of our difference in the types of models, visit our website, gutenbergresearch.com, and click on the Education tab. We go through the full details of our types of models. We do an introduction of financial modeling. For our tier 1 models that use a DCF approach, we show you how we calculate the inputs and how we actually calculate the discounted cash flow valuation. and then we go through the details of our market multiple valuation. So there's a video that explains each one of those items there. But going back to this model, let's talk about the valuation. So shares are right now trading at about $9.50 per share, which represents a valuation ex cash of about 38 times the 2017 price to EBITDA ratio. And that is about the average ratio over the last 3 months or so. So, the valuation for Pandora is just all over the place, though, right now. So it's so difficult to predict. And if there's more bad news this quarter, it could change so much. And, the bad news might not even be up front because they're estimating such a wide loss. So if this loss is even wider than what the street is looking for in the first quarter, it may or may not have a significant impact overall. It's really going to be about when they're able to get back to profitability, and they'll just have to show that under the new royalty rates that they can be a profitable business, and that some of these new ventures that they're going into will pay off hopefully sooner rather than later, especially since the expenses associated with them are up front. So there's going to be a lot to listen for on tonight's call. Check back after the release. We'll update the March quarter and we'll update the 2016 full year details based on management's new guidance. Thanks for watching and good luck with the release.